Imagine you wake up one morning in May 2022 and check your crypto portfolio on your phone, the same way you've been doing every day for the past 2 years during the bull run. You've got $200,000 in Terra USD because everyone said it was a stablecoin pegged to the dollar that earned you 20% APY on Anchor Protocol, which seemed too good to be true. But Do Kwon, the founder, with his cocky Twitter presence, kept saying, "I don't debate the poor," and 95% of other stablecoins will die before UST does. So you trusted him. You've also got Luna, the sister token that was trading at 116 just a month ago in April 2022, making Terra the third largest stablecoin by market cap behind Tether and USDC. And this morning, May 9th, 2022, you watch in real-time horror as UST loses its $1 peg and drops to 0.98, then 0.95, then 0.90, and you think, okay, this is just temporary volatility, it'll bounce back because algorithmic stablecoins are supposed to be mathematically impossible to break. But then May 10 arrives and UST is at 0.35, and Luna, which was 116 a month ago, is now $30. You try to sell? But everyone else is trying to sell too. The Luna Foundation guard that Do Kwon created with $3 billion in Bitcoin reserves is desperately trying to defend the peg by selling Bitcoin, which crashes BTC from $40,000 to $30,000, adding more panic to the entire crypto market. And by May 11, Luna is under $1. By May 12, it's trading at 0 days and 1 ding, essentially zero. Your $200,000 in UST is now worth $4,000 if you're lucky. And this isn't just you. $40 billion in market cap has evaporated in 72 hours, the fastest and largest destruction of wealth in crypto history. Retail investors from South Korea to Singapore to India who put their life savings into Terra are posting suicide notes on Reddit. The R cryptocurrency subreddit has to pin suicide prevention hotlines to the top of the forum. And Do Kwon, who was the king of the lunatics, as his fans called themselves, is nowhere to be found. He'll later try to flee using fake Costa Rican and Belgian passports and get arrested at Podgorica Airport in Montenegro in March 2023. And in December 2024, he'll be sentenced to 15 years in federal prison for what the judge called fraud on epic generational scale, after admitting he lied to investors about the safety of his algorithmic stablecoin that was always mathematically doomed to fail because you cannot maintain a $1 peg purely through arbitrage between two volatile crypto tokens without real collateral. But the Terra collapse on May 7th of 2022 is just the first domino, because a Singapore-based crypto hedge fund called Three Arrows Capital, or 3AC, that managed up to $18 billion in assets, had invested $600 million in Terra's Luna Foundation guard, and that money is now worth zero. 3AC was run by two Columbia University graduates, Kyle Davies and Ju Su, who started the fund in 2012 and became legends in crypto by making huge leveraged bets on everything from Bitcoin to Solana to Polkadot to Avalanche to Axie Infinity. They led a $150 million funding round for Near and a $230 million round for Avalanche. They lived in a $50 million yacht. Ju Su bought a $35 million good-class bungalow in Singapore in March 2022 and put it in his 3-year-old son's name, presumably to hide it from future creditors. They borrowed money from everyone. BlockFi lent them $400 million. Genesis lent them hundreds of millions. Voyager Digital lent them $670 million in Bitcoin and USDC. And 3AC used all that borrowed money to make massive leverage bets that worked great when crypto was going up but became catastrophic when Terra collapsed and Bitcoin crashed from $69,000 in November 2021 to $30,000 and then to $20,000 by mid-June 2022. Suddenly 3AC couldn't meet its margin calls. On June 15, 2022, BlockFi and Genesis started liquidating 3AC's positions. On June 27th, Voyager announced that 3AC had defaulted on its $670 million loan and would not be paying it back. That same day, June 27th, 2022, a court in the British Virgin Islands where 3AC was incorporated ordered the company into liquidation. 3AC filed for Chapter 15 bankruptcy in the U.S. on July 1st, 2022. And here's where it gets really ridiculous. Ju Su and Kyle Davies went completely silent and refused to cooperate with liquidators. Ju Su filed himself as a creditor, claiming 3AC owed him $5 million He literally listed himself as someone the bankrupt company owed money to while hiding from creditors. Neither founder has been found to this day, though there are rumors they're living in Dubai or the UAE, and 3AC's collapse triggered a catastrophic domino effect because Voyager Digital, which had lent 3AC $670 million, couldn't recover that money and filed for Chapter 11 bankruptcy on July 5, 2022, owing $1.3 billion to over 100,000 creditors who had trusted the platform with their crypto. Celsius Network, which had promised users unbank yourself and offered 20% APY on crypto. Deposits had lent heavily to 3AC and other risky players, and on June 13, 2022, Celsius froze all withdrawals for its 1.7 million users, citing extreme market conditions. People had tens of thousands of dollars, sometimes hundreds of thousands, locked in Celsius, unable to access their money, and Celsius CEO Alex Mashinsky had been on Twitter and YouTube for months telling people to withdraw money from evil banks and put it in Celsius for amazing yields. He personally cashed out $10 million in CEL tokens at the top of the market. Before the freeze, while retail users were trapped, Celsius filed for bankruptcy on July 13, 2022, with a $1.2 billion hole in its balance sheet, and lawyers are now arguing that users gave up legal ownership of their crypto when they deposited it on the platform, meaning they might never get it back. BlockFi, which was one of the largest crypto lenders, got crushed by its exposure to 3AC and had to accept an emergency bailout from FTX in July 2022 for $400 million, giving FTX the option to acquire BlockFi, but that bailout turned into a death sentence when FTX itself collapsed 4 months later in November 2022, taking BlockFi down with it and forcing BlockFi into bankruptcy on November 28, 2022. Genesis, which is the crypto lending arm of Digital Currency Group, owed by Barry Silbert, had lent heavily to 3AC and froze withdrawals on November 16, 2022, eventually filing for bankruptcy on January 20, 2023, and the total market capitalization of cryptocurrency, which peaked at $3 trillion in November 2021, crashed to $800 billion by November 2022, a $2.2 trillion destruction of wealth in 12 months. Bitcoin went from $69,000 to $1,500, Ethereum from $4,800 to $900. And if you think this is bad enough, wait until I tell you about FTX, because while all these companies are collapsing through the summer of 2022, Sam Bankman-Fried, or SBF, the 30-year-old wunderkind CEO of FTX, who was worth $26 billion on paper and being called the JP Morgan of crypto for bailing out distressed companies, who did effective altruism and lobbied Congress for crypto regulation and bought Super Bowl ads and got celebrity endorsements from Tom Brady and Gisele Bündchen and Larry David and Steph Curry and Shaq. This guy was literally stealing billions of dollars of customer money, and nobody knew. FTX, which SBF founded in 2019, grew to become the second largest crypto exchange in the world, valued at $32 billion in January 2022. Customers deposited money on FTX to trade crypto, and those deposits were supposed to be kept safe in TEC segregated accounts, but SBF had created a secret backdoor in FTX's code that allowed his trading firm, Alameda Research, run by his ex-girlfriend Caroline Ellison, to withdraw unlimited customer funds without triggering any alarms. Starting in 2020 and accelerating in 2022, SBF and Alameda borrowed at least $8 billion of FTX customer money to make risky venture capital investments, to pay back other loans, to buy real estate in the Bahamas, to make political donations, to bail out BlockFi and other companies, all without customers' knowledge or consent. When Terra and 3AC collapsed in Debegadion, May-June 2022, Alameda Research, which had been making huge leveraged bets on crypto, suffered massive losses, and SBF funneled more FTX customer money to Alameda to cover the losses. By summer 2022, Alameda owed FTX $14 billion but only had about $5 billion in the assets on its balance sheet, mostly consisting of illiquid FTT tokens, which were FTX's own exchange token. On November 2, 2022, CoinDesk published an article showing that Alameda's balance sheet was heavily dependent on FTT tokens. This spooked the market. On November 6, 2022, Changpeng Zhao, or CZ, the CEO of Binance, which is FTX's biggest competitor, announced he would sell all of Binance's FTT holdings worth $580 million This triggered a classic bank run. Everyone tried to withdraw their money from FTX at once. Customers tried to withdraw $6 billion in 3 days. FTX didn't have the money because SBF had already stolen it and given it to Alameda on November 8, 2022. FTX froze withdrawals on November 9th. Binance announced it would acquire FTX, but then did due diligence for literally a few hours, looked at the books and said, "Holy shit," and walked away from the deal. On November 11, 2022, FTX filed for bankruptcy. SBF resigned as CEO and was replaced by John J. Ray III, who had overseen Enron's bankruptcy, and said FTX was the worst corporate failure he had ever seen in his entire career. "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information," Ray said. "There was no board of directors, the accounting was done in QuickBooks, corporate funds were used to buy personal homes and vacations, FTX had over 1 million creditors, $8 billion in customer money was missing, and SBF went from being worth $26 billion to literally zero overnight." He was arrested in the Bahamas on December 12, 2022, extradited to the U.S., tried in federal court in Manhattan in October-November 2023. Caroline Ellison, his ex-girlfriend and Alameda CEO, testified against him, explaining how SBF explicitly told her to commit fraud. Gary Wong, the CTO, testified that SBF ordered him to create the secret code that let Alameda access customer funds. Nishad Singh, the head of engineering, testified SBF knew everything. The jury convicted SBF on all 7 counts of fraud and conspiracy on November 2, 2023, and on March 28, 2024, Judge Lewis Kaplan sentenced him to 25 years in federal prison, saying, "There is absolutely no doubt that Mr. Bankman-Fried knew what he was doing was wrong and criminal, and the human cost of all this is staggering." Meet Jason, 34 years old, from Singapore, software engineer, had $180,000 in UST, earning 20% on Anchor Protocol, was planning to use it as a down payment on a house, watched it become worth $3,600 in 3 days, couldn't afford the house, still renting, fell into depression for months. Meet Sarah, 28, from Seoul, South Korea, put her entire life savings of $85,000 into Luna. At $90, thinking she was investing in the future of money, it went to zero. She had to move back in with her parents, abandoned her dream of starting a business. The Luna collapse disproportionately hit South Korea, where crypto was huge, with over 200,000 Korean investors holding Luna. Meet Mike, 42, from California, had $310,000 on Celsius earning yield, needed that money for his kids' college tuition and his mother's cancer treatments. Celsius froze withdrawals. June 13, 2022, still hasn't gotten his money back 2 years later. His mom couldn't get the treatment she needed. Meet David, 39, from New York, trusted FTX with $550,000 because SBF seemed like the responsible one bailing out everyone else. FTX collapsed. The bankruptcy court is still sorting out who gets what, but he might get back 10-20 cents on the dollar if he's lucky, several years from now. And these aren't isolated stories. Millions of ordinary people lost everything. There were at least several verified suicides linked to Luna's collapse, though the real number is certainly higher. People lost homes to foreclosure after taking out loans against their Terra holdings. People couldn't afford medical treatments. Kids couldn't go to college. Retirement savings disappeared. And the thing about crypto compared to traditional finances, there's no FDIC insurance, no bankruptcy protections for most users, no recovery process. When your exchange goes bankrupt or your stablecoin collapses, you just lose your money and there's almost no legal recourse. Do Kwon's victims won't recover anything meaningful. 3ACs. Creditors are fighting over scraps. Celsius users are getting maybe 30-40 cents on the dollar years later. Voyager users got some back after being acquired by Binance, but at a huge discount. FTX users might eventually get some portion back, but only because the bankruptcy estate got lucky with some investment increases, and the people who ran these companies face almost no consequences compared to the devastation they caused. Do Kwon is in prison for 15 years, which is something. SBF got 25 years, which is actually a lot, but Jusu and Kyle Davies of 3AC are living free somewhere, spending investor money on yachts and mansions. Alex Mashinsky of Celsius was arrested but hasn't been convicted yet and withdrew millions at the top. The crypto industry spent 2023-2024 trying to rebuild credibility, but the damage is permanent. Total crypto market cap did eventually recover to $3 trillion by late 2024, driven by Bitcoin's rise and the approval of Bitcoin ETFs. But that doesn't help the people who lost everything in 2022. They're not getting their money back. Jason won't get his house. Sarah won't get her business. Mike's mom didn't get her cancer treatment. David lost his life savings. And what's truly insane is that all of this was predictable. Every single red flag was visible if you looked. Algorithmic stablecoins like UST have failed every time they've been attempted in history because you cannot maintain a peg purely through arbitrage without real collateral due. Quan himself had created a failed algorithmic stablecoin called Basis Cash in 2020 under a pseudonym that collapsed in exactly the same way, but nobody did the research to figure out it was the same guy. 3AC was obviously over-leveraged and interconnected with every major crypto lender, but nobody cared. During the bull run, Celsius was offering 20% APY, which is impossible. Without massive risk or fraud, the math literally doesn't work. FTX had no board of directors, no proper accounting. Customer funds weren't segregated. The terms of service explicitly said they wouldn't lend customer funds. But they were doing exactly that. Every single warning sign was there, but people ignored them because number go up felt good. Crypto influencers on Twitter and YouTube were pumping Luna and Celsius and FTX right up until they collapsed because they were getting paid referral fees. Nobody wanted to be the person saying this is a Ponzi scheme because you'd get attacked by the cult-like communities, and regulatory agencies were either asleep or deliberately ignoring the problems. The SEC had been investigating Terraform Labs since 2021 but didn't stop Do Kwon from continuing to sell UST to retail investors. The Commodity Futures Trading Commission knew about FTX's issues but didn't act until after the collapse. Bahamian regulators gave FTX a license. Despite obvious red flags, South Korean regulators knew Luna was a problem but let it grow to a $40 billion market cap before doing anything. And this pattern repeats throughout crypto history. It's not a bug, it's a feature of an industry built on hype and speculation rather than fundamentals. And the crypto winter of 2022, starting with Terra's collapse on May 7th and ending with FTX's implosion on November 11th, represents the fastest and most concentrated destruction of wealth in the history of a financial asset class. $2 trillion gone in 6 months, several million people's lives changed forever, and the lesson is clear. When something promises returns that are too good to be true, when the founder acts like an arrogant cult leader, when the business model doesn't make mathematical sense, when there's no real regulation or oversight, when everyone around you is getting rich and saying you're missing out if you don't join, those are the exact moments to run away as fast as possible. But human psychology doesn't work that way. FOMO is stronger than logic, greed is stronger than caution, and the next crypto bubble, whenever it comes, will feature the exact same patterns and the exact same people will lose money for the exact same reasons because we never learn. The alternative. History, What if crypto had real guardrails? But imagine a different timeline. Imagine that in 2018, when algorithmic stablecoins first started gaining traction, the SEC or the CFTC or the Federal Reserve or any financial regulator had said, wait a minute, you're creating a financial product that purports to maintain a stable $1 value purely through arbitrage between two volatile, unbacked tokens with no collateral. That's a security and you need to register it and prove it works, or you can't sell it to retail investors. Imagine Do Kwon has to submit mathematical proof that his algorithmic stablecoin can withstand a bank run before he's allowed to market it. He can't. Because the math doesn't work, algorithmic stablecoins are fundamentally impossible to maintain under stress without real collateral, so either Do Kwon changes the design to use actual collateral like USDC does, making it boring but safe, or he's not allowed to launch at all. In this timeline, Terra never gets to $40 billion market cap, the lunatics never exist, Do Kwon never becomes a Twitter celebrity saying, "I don't debate the poor," and 200,000 South Korean retail investors don't lose their life savings in May 2022. Alternatively, imagine that Three Arrows Capital has to register as an investment advisor under the Investment Advisors Act, which requires them to disclose their positions, their leverage ratios, their counterparty exposures. The SEC can see that 3AC is borrowing $10 billion to make bets on illiquid venture capital investments and highly volatile crypto assets. They can see that 3AC has no risk management. They can see that if Bitcoin drops 50%, the whole fund implodes. Regulators can either force them to deleverage or warn their lenders that 3AC is a ticking time bomb. In this timeline, when Terra collapses, 3AC might still take losses, but they're not over-leveraged enough to blow up. And even if 3AC does fail, their lenders like Voyager and Celsius and BlockFi have been warned and didn't lend them $2 billion in aggregate. Or imagine that. Crypto lending platforms like Celsius and Voyager have to follow the same rules as banks. They need capital requirements. They need to hold reserves. They need to disclose where customer deposits are going. They need to get audited. Alex Mashinsky can't lie to customers that Celsius is safer than a bank while secretly lending their money to 3AC with no collateral. If Celsius wants to offer 20% APY, they have to explain how they're generating those returns and prove it's sustainable. Spoiler alert, they can't, because the only way to pay 20% is to take massive risks or run a Ponzi scheme. So either Celsius offers 3 to 4% like a normal savings account, which is boring but honest, or they're not allowed to operate. In this timeline, 1.7 million Celsius users don't lose their life savings. Or imagine that FTX has to follow basic exchange regulations. Customer funds must be kept in segregated accounts. You can't lend customer deposits to your affiliated trading firm. You need independent directors. You need proper accounting. Not QuickBooks, you need regular audits. The Bahamas, where FTX was based, has basically zero crypto regulation. But imagine the US said, if you want American customers, you have to follow American rules. SBF either complies and can't steal $8 billion of customer money, or he only operates in unregulated jurisdictions with no US customers, dramatically limiting his reach. In this timeline, FTX might still be a successful exchange, or if SBF is fundamentally a fraudster, maybe FTX never gets big because he can't commit fraud under proper oversight. And the key realization is that all these disasters were completely preventable with regulations that already exist for traditional finance. We figured out in the 1930s, after the Great Depression, that you need the SEC to prevent securities fraud, the FDIC to ensure deposits, capital requirements for banks, segregation of customer funds, regular audits, mandatory disclosures. These rules exist because we learned the hard way what happens without them. But crypto marketed itself as an alternative to the traditional financial system, specifically to avoid those regulations. Unbank yourself was Celsius's slogan. DeFi means decentralized finance with no intermediaries. Algorithmic stablecoins were supposed to be better than fiat-backed stablecoins because they didn't rely on regulated entities. The entire ideology of crypto was that code and game theory and incentives could replace regulation and oversight. And 2022 proved definitively that this doesn't work. Every single failure in crypto winter 2022 could have been prevented or massively reduced with basic regulatory oversight. And here's the beautiful irony. By late 2024, the only crypto companies that survived and thrived are the ones that accepted regulation. Coinbase, which registered with the SEC and follows compliance rules, is still standing. Circle, which backs USDC with real dollar reserves and gets audited, is still standing. Regulated crypto ETFs got approved in 2024 and are bringing billions of institutional capital to Bitcoin. Meanwhile, every company that tried to operate in the shadows or in unregulated jurisdictions either failed or is under investigation. So the alternative timeline where crypto had guardrails from the beginning isn't science fiction. It's what we're slowly moving toward now, except it costs $2 trillion and millions of ruined lives. To learn this lesson, imagine if in 2018, when crypto was still relatively small, regulators had said, okay, you want to create alternative financial products, that's fine, but you have to follow the same rules as everyone else. No algorithmic stablecoins without proof they work. No lending customer deposits without proper risk management. No exchanges without segregated accounts and audits. The crypto industry would have fought this tooth and nail. They would have called it tyranny and regulatory overreach and claimed it would kill innovation. But what would have actually happened is the scams and Ponzi schemes would have been filtered out early. Only legitimate projects with real use cases and honest business models would have survived. Do Kwon wouldn't have become a cult leader because his stablecoin wouldn't have been allowed to launch. 3AC couldn't have over-leveraged to $18 billion because disclosure rules would have exposed them. Celsius couldn't have promised 20% because they'd have to explain where it comes from. SBF couldn't have stolen customer funds because proper accounting and oversight would have caught it immediately. And yes, maybe crypto would have grown slower. Maybe it wouldn't have hit $3 trillion market cap in 2021. Maybe we wouldn't have seen 100x gains on shitcoins, but also we wouldn't have seen $2 trillion disappear and millions of people lose everything. The alternative timeline is one where crypto is boring, where it grows steadily as a legitimate part of the financial system, where people can use it without fearing their entire investment will disappear overnight, where innovation happens but within guardrails that protect consumers, and that alternative is still possible. The crypto industry today is slowly accepting that regulation isn't the enemy. Companies are registering with the SEC, getting audits, implementing KYC and AML, working with regulators instead of fighting them. Bitcoin ETFs are bringing crypto to 401ks and pension funds. Stablecoins are being backed by real reserves. The Wild West era is ending, but it didn't have to be this way. We didn't need to lose $2 trillion to learn that financial regulation exists. For good reasons, we could have had this alternative from the start if the crypto industry hadn't been so ideologically opposed to any form of oversight. And for Jason and Sarah and Mike and David and millions of others who lost everything in 2022, this alternative timeline is bitter to contemplate because it didn't happen. They're not getting their money back. The house is gone, the business is gone, the medical treatment is gone, the college fund is gone, and all of it was preventable.